Hi, my name's Tom Corley. I'm the author of the best-selling book, Rich Habits, and I'm honored to have with me today Roger Daisley. He's been in financial services for over 40 years, and he's written 4 financial industry publications. He is the author of The Guide to College Funding, 10 Ways to Fund a College Education Without Giving Up Your Retirement. Hi, Roger. How you doing today?
I'm doing just fine, Tom. How are you today?
Fantastic. That is a great topic for a book. You know, there's so many people that are struggling financially today. You've got your home, you've got your retirement, and you've got college education, which has been rising at about 7% a year. And people just don't know what to do. And your book, 10 Ways to Fund a College Education, is really timely. It's important information, and you've got a lot of strategies in there. And I was just hoping you could share with us some of the saving strategies for our listeners.
Well, that'd be great. The one thing I'd like to start out with is something very simple. Start saving now. It doesn't matter whether you're in early stage of pregnancy or you've got a toddler. The sooner you start, the better it is. And then the trick is, anytime you come into money, whether it's an increase at work, a bonus, you find money, you inherit money, immediately take half of it and put it into the college fund. If you do that, you won't miss it. It will not have become part of your lifestyle. And it's a way to start accumulating money because, quite frankly, you're always better off if you have the money and don't need it, as opposed to needing the money and not having it.
Roger, when is really the best time to start saving for college?
The earlier, the better. Keep in mind, compound interest is really a miracle that works to your advantage. The sooner you start to save, the more interest it's going to accumulate over that period of time. There's all kinds of things that educational consultants can do at the end. So if you haven't saved any money, well, you desperately need to see them, and they can still probably save you, for the more expensive school, tens of thousands of dollars a year in education costs. But it's so much better if you start when the child is young.
Are there any favorite strategies like the 529 plan or the Coverdells that you like to focus on or think have a better chance of growing the college funding money for a young family?
Well, there's lots of things to take into consideration, and there's no one size fits all. It really depends upon the personal financial situation of the family involved. However, the most common way people are saving money for college is through savings accounts at banks, which is very low interest rates. The next most common are the 529 plans. But again, over a 20-year period, if you look at the DALBAR reports, it's all capital letters, DALBAR. It's an organization in Boston that studies mutual funds. Quite frankly, they haven't really kept up. We've had some interesting times, let's say, with the stock market over the last 10 or 15 years. So that's another plan. And also keep in mind that both plans tend to reduce the amount of financial aid you can qualify for. So there are other things, there are other tools that exist. One little comment on the Coverdell. The good thing about a Coverdell is that you can use it for secondary school education. So if you want your son or daughter to go to a private high school, that's one way to accumulate money. The other way is a little bit more difficult to consider because the Coverdell plans only allow $2,000 annual contributions, and that's cumulative. You can't have $2,000 by an aunt or an uncle contributing. It's just going to a total of $2,000. And with many mutual funds, the expenses of administering the fund are more than the profit that you're going to make. So you want to be really careful when you do that.
Yeah, that's a very good point on the Coverdell. And also, I think there's some restrictions on the Coverdell in terms of you have to pull the money out at some point.
Yes. There's all sorts of limitations, both with the 529s and the Coverdells. They both are good plans. They work for certain advantages, but yes, the Coverdell, you're limited, and although they keep changing these things, I think it's age 30. But the 529 plans do have the flexibility of being able to transfer from one child to another, to your spouse or yourself. You can even transfer the assets to first cousins without having to deal with the penalties.
Yeah, that's a lot of flexibility in the 529 plans. I like to look at the way to fund college or the means to funding college as really 3 strategies. savings, loans, and scholarships. In your book, you have this matrix, it's flowchart, on the complexity of the financial aid and that whole process, FAFSA. Can you get into that a little bit and maybe try and help simplify it or make it understandable to the average viewer there?
Believe it or not, I had that given to me, and it was taken right from the Department of Education website. And it's entitled Financial Planning, Financial Aid Made Simple. And then at the bottom, and it says Simplified View. And if you had a picture of that, and you really can't appreciate it unless you get it really blown up, it is just a confusing situation. So again, what is your strategy? You've got to save money. Okay, fine. We've got that. And there's lots of tools you can use, whether it's insurance policies or 529s or savings at plants or buying real estate. I mean, there's a million different ways to save. But obviously, I keep emphasizing you've got to start saving. Secondly, I want to kind of caution people for the pitfalls. School guidance counselors have a very, very important function. They're usually good at giving advice to which types of colleges the child should apply to, but most of them have not taken the specialized study to learn how to complete the FAFSA form. It's a 100-question form, but the instruction booklet's over 1,100 pages long. So accountants, guidance counselors, anybody else that you might want to talk to is going to have a problem if they haven't sat down and really studied that material, learning how to put your best foot forward. From there, you have to then say, okay, I'm trying to think of an easy way to explain this. A lot of people do their own taxes, but some people hire accountants. And the reason they hire an accountant is the accountant has had specialized training. They know what can be deducted, what can't be deducted. And it's that specialized training that normally ends up with you not having to pay as much taxes.
Right.
It's the same thing with a financial aid consultant. They've had the specialized training so that they can show you legally how to put your best foot forward so that you can qualify for the most financial aid. So that's step one. How do you qualify for the most? And through the Department of Education's formula, you come up with what the Department of Education determines is your EFC, or effective family contribution. Now, once you have that number, the next thing is to find out which colleges will provide the most of that. They don't automatically provide 100% of the balance. So in addition to what the government determines you should be paying, you're going to have to pick up the slack. So finding out which colleges pay the most, provide the highest percentage of that effective family contribution is the first step. Second thing is, let's face the fact, it's better when you don't have to pay back the money. So then, which schools will provide the most grant money?
Good point.
So that when you graduate, you don't have this big albatross of $22,000 to $25,000 around your neck, because you've probably been aware of the fact that over 50% of the college graduates can't get a job within the first year of graduation, and yet those loans are expected to be paid.
Yeah, and there's, it's almost from an advisor standpoint, when you're advising on, college funding and preparing the kids for a college education, one of the points that I like to make is, if you have to go for these student loans, make sure that the kids are going into a curriculum that's going to be able to get them a job, and they're not going to be part of that 50%. One of the other things I wanted to ask you, Roger, was the FAFSA. FAFSA is the application, the federal application that goes to the colleges, it goes to the federal government, and this is how all the student loans and the grants and the money from the colleges and the federal government are, it's the information that they use to provide those funds. When's the best time for parents, if they have, say, someone who's going into their senior year in high school, when's the best time for them to start thinking about the FAFSA and getting that FAFSA application in?
I don't mean to give these short answers, but basically yesterday was the best time. Money is awarded based on a first come, first served basis. So you cannot turn in the FAFSA form until January 1st, but it is to your advantage to do just that. If you can get it in the first week of January, that's going to put you way ahead of a whole lot of other people that are going to be somewhat lackadaisical about getting the form in. The schools also have their own regulations as to when the admissions forms, all of the entire package has to go together. So yeah, it's good to start looking at a FAFSA form when your son or daughter is a junior in high school so that you can become familiar with what type of questions are being asked, and then just move forward from there. Because that gives you time to basically reposition your assets so that you can put your best foot forward. Now, I want to differentiate between the way a college looks at these forms and the way the federal government looks at these forms. As far as the federal government is concerned, it is cheaper for them to provide subsidy for education than it is to provide subsidy for retirement. So any assets that you have that are called retirement plans by the Department of Education is money that does not count against you when qualifying for financial aid. Now, that's money that's already accumulated. Keep in mind, any current contributions into a retirement plan would count against you on the financial aid.
That's a good point. Talking about some of the tax strategies to save for college, what are your favorites, and can you give us some information on why you like them?
There's a lot of different methods that you can use. Again, it depends upon the family, but one of the methods that's not covered very much is to use traditional life insurance products. When I'm talking to grandparents, I usually use a product called a 10-payment life with a traditional mutual and company that's not direct recognition. Now, I realize I just said a mouthful, but I won't go into all those details. Mm-hmm. The bottom line is that the grandparents may not think they can live forever, but they certainly expect to live the next 10 years. So they can put the money into the 10-payment life. The money accumulates income tax-free. And when it's time for your son or daughter to go to school, they can borrow the money from the policy to pay for the college costs. And then, since the premium has already been totally completed, the dividends that are coming each year of the policy can repay the loan on that policy so that the child ends up with a lifetime of a life insurance policy without having to put any money in that can subsequently subsidize their retirement. So that's a good thing for grandparents. There's another plan of insurance I like to use for parents, and this is a little different. It's called a life paid up at age 65. Again, both these plans, the emphasis on the savings more than the death benefit. Mm-hmm. But with the life paid up at 65, the insurance protection is on the life of the parent. When the child becomes 18, 17, 18, 19, they can use the exchange of lives provision and transfer the policy from the parent to the child. In the process of doing this, you release the reserves on the policy, and that's usually enough money to pay all, or if not all, most of the cost of college education, assuming, of course, they put enough money into the plan. And of course, I don't want to overlook the 529 plans. They do have their place. You put the money in, it works somewhat similar to a Roth IRA. You do not get the tax deduction, but the money accumulates income tax free, which means let me call it interest that the plan earns each year will stay intact and be earning interest, as opposed to a plan where some of that interest would have to be used to pay income taxes.
Right, and you know, the one caveat I'd like to throw out there on the 529 plans is we saw this with the recession, Roger. A lot of people had money in the 529 plans. You can't control that money, right?
No.
That's something that's controlled by the state, sort of outsources it to the big brokerage houses and mutual fund companies. So you can actually see the 529 plan money go up and down, and you can't really do anything about it except I think you can transfer it once a year out of the plan. Besides the 529, the Coverdell, how about some of these tax deductions that are offered? You know, when you file your income tax return, as long as you qualify for the tax deductions, can you talk about a little bit about the lifetime learning credit, the other credits that are available and deductions?
Well, the Hope Lifetime Learning Credits, those are credits that are primarily for low-income families. And as a result, it's a tax credit. So it's not the same as a deduction. The credit just means that much less taxes you have to pay, and they are very helpful. But another whole category that I have a lot of fun talking about, particularly when I go to Chamber of Commerce meetings, I love to talk to business owners, and today there are so many people that are small business owners operating out of their homes because for whatever reason their companies failed or let them go when they cut back. And there are so many opportunities to take tax deductions. For example, in a family-owned business, they can set up a plan that'll allow the business to deduct the full expenses up to about $5,200 a year. I'm rounding this off. They can also pay their children's salaries. Now, it has to be legitimate, but kids today know so much more about computers than we ever did. And so you could hire perhaps your older child to be your web administrator. That's a job that you can pay them for, and they can continue to do that for you while they're in college. Now, by paying them, you're taking your income and reducing it so you pay less taxes, and more than likely your children are going to be in a smaller tax bracket.
Right.
Suppose you have a younger child, early teens. You can hire them to file paperwork, to make proposals, to respond to mail, things of that nature. You can even hire younger children to do simple tasks like empty the garbage pails and things of that nature. Now, again, you've got to be realistic, otherwise the IRS is going to come down on you. But by doing things that way, you're dramatically reducing your taxes.
Yeah.
Another thing, go ahead, I'm sorry.
There's an interesting strategy that one financial advisor was using. They had their client, their business client, hire their children to be models for a lot of their marketing material. And they use that money to fund IRAs, Roth IRAs, which I think is a unique strategy in that the Roth IRA money, you can pull that money out, at least the contributions. And this financial advisor was using the Roth IRA money to accumulate college funding, as well as some other 529 plans and things like that. And I thought that was unique.
Yeah, that's a very good approach because, as you said, with the Roth, there's no tax deduction. So you can take your principal out at any time and not have any tax ramifications. And so that's a very effective way to do it. And one of the many, again, in the interest of time, I can't go down the whole list,
right.
But that is a technique that we have used. It depends, again, I keep coming back to it. It depends upon the specific family situation. Everybody's different.
Yeah, it really is, because your tax situation oftentimes drives what benefits, what strategies you are going to use. So you're right, and that's where having a good financial advisor that understands taxes is important, especially with the college process. Are there, I guess, 3 of your favorite tips that you could leave for the audience that they could use today to really get on a good start on this college funding?
I think I've kind of touched on a few of them, but let me elaborate just a little bit. The first thing is to get started. As I mentioned, the sooner you start, the more time whatever investment you have is going to work to your advantage. That's the first and foremost. The next thing I would do is to make sure you understand who you can go talk to. Remember, the financial aid officer at the college is a salaried employee of a business. His job is not to give away money. So they're good at directing you to get loans. They're good at following whatever paperwork to get grants, but they're not your best source of information. And as I said earlier, the school guidance counselors, they're pretty good at what they do, but again, most all of these people have not had specialized training in how to put your best foot forward. The last thing I'd like to say is that at different times in life, we all come up with money somehow, some way, whether we inherit it, whether we get a bonus, whether we get an increase at work. If immediately you take half of that money and put it into your college savings plan, you'll never miss the money. If you wait as much as a month to do that, you're going to find that, how's the expression go? a luxury once acquired becomes a necessity, the new money will become part of your daily cost of living, and you're just not going to hit your savings goals.
Yeah, and there's, people are struggling with retirement, their mortgage and college funding, and, they're looking for expert advice. They're looking for books like yours to help guide them on this process. And with respect to finding that guidance, you brought up the point about the guidance counselors. What can people do who are really looking for advice? There are advisors out there that you pay to help you, as you mentioned, with the financial aid process, even guiding you through the entire college application process. What are your recommendations to those individuals who just don't know where to turn and are contemplating seeking out professional advice? What tips can you give them?
The first and foremost would be talk to an educational financial aid advisor. There's people like me all over the country. They've all had the specialized training, and they will be able to guide you. The earlier that you can talk to someone like that, the better off they can help you position your assets, help you decide on what the best savings vehicles are for you with your particular family situation. And of course, they can also guide you into process. Keep in mind that something like 85% of all students are in a career totally unrelated to their college degree within 24 months of graduation. Mm-hmm. With that in mind, it doesn't matter what degree you get. Therefore, they can coach you and your son or daughter on how not to get involved with one of these deals where you're switching majors 2 or 3 times while you're at college. If it takes the average person 5.8 years to graduate with a 4-year degree, that's a lot more years of tuition and, of course, room and board expenses. Think of how much better it would be if you could get out of school in 3 years, because that would put you in a position where you're going to get the first jobs. And that's really what you're driving for. You're taking college education so that you can get a good career.
I think that's a fantastic point. Roger, it was a pleasure having you on the air today. Really good information. And again, I want to mention the book, 10 Ways to Fund a College Education, and the subtitle is Without Giving Up Your Retirement. Very important information in this book. And again, thank you so much, and we appreciate having you on Focus Forward.
Thank you, Tom. I really appreciate it.